Welcome to the next of our videos with an FA1 recording financial transactions. This video will be about double entry bookkeeping. Until now we didn't put a lot of care about that. We were talking about books of prime entry, which were not a double entry system. It was just a method of recording all transactions. However, then we sort of jumped straight to financial statements, where we looked at statement of financial position and statement of comprehensive income. Now, when we made that jump, well, underneath us was the whole T accounts system with classification of transactions and double entry bookkeeping. So this is what we will focus on now, the debits and credits. If anyone knows anything about accounting, it's always about debits and credits. And there's an enormous number of jokes about accountants, usually also focusing around debits and credits. So what are those debits and credits in general? Now, the whole double entry system was invented in 15th century by an Italian called Luca Pacioli. He was sitting in his garden, probably, and thinking about transactions. He was a banker, like a number of Italians at that time, and he suddenly found out that every transaction has a dual effect. All right, let's look at this. We receive goods from supplier. Now, on the one hand, we have goods. That's good. We own something, so that's our asset. However, on the other hand, we owe money to supplier. So we owe something. We have a payable, which is a liability. Right? And the same logic can be applied to any type of transaction. When we sell something, well, that is a more complicated thing. That's actually two things at the same time. On the one hand, we have receivables. Someone will pay us. On the other hand, we made a sale, so we have revenues. That's part A of the deal, but the dual effect is still here. Part B will be that, well, on the other hand, our inventory goes down because we sold some goods. So we have less assets and we will have something that is called cost of sales. These two together will make a profit on the transaction. Yet another thing. Yet another type of transaction will be when we get a bank loan. On the one hand, we have more cash, that's assets. But on the other hand, we owe it to the bank. That's a liability. Now, in general, any increases in assets or decreases in liabilities or decreases in equity because they will work in the same way, we will call debits. Any decreases to assets or increases in liabilities or increases in equity because they work in the same way will be called credits. There's one more thing to explain. What about revenues and expenses? Well, all items of income are credits and all expenses are debits. Now, how to remember that? The easiest way to remember, I think personally, is by always imagining this in the form of a balance sheet, where you will have assets, equity, and liabilities. So these will all be debits, these will all be credits. However, one thing to remember is that within equity, one part of equity is the profit. Because any profit that the company makes belongs to the company's owners. So profit is part of equity. Now profit is revenues or income minus expenses. And we know that anything that increases equity is a credit, and anything that reduces equity is a debit. And that is the way to remember that expenses will always be debits and revenues will always be credits. In your notes on page 20, you have a table which summarizes these rules. Please remember that, because that is one of the cornerstones of accounting in general. It all starts from a T account, which has a debit and credit side, and it goes on up to the statement of financial position, which has assets and equity and liabilities. It's all the same principle.